Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. Scots went to the polls on Thursday to elect members of the Scottish Parliament, which has powers over non-national competencies like health, education and the environment. The result will also have an impact on whether or not there will be a second referendum on Scottish independence. Nicola Sturgeon's Scottish National Party favours leaving the United Kingdom and rejoining the European Union, and a victory for the SNP will put pressure on the British government to consider holding a referendum. Because of COVID restrictions, the final result will only be known by Sunday, however. As of Thursday night, nearly 157 million people have been infected with COVID-19 worldwide, and 3.27 million deaths have been recorded thus far. The United States remains hardest hit, with over 33 million infections and more than 594,000 deaths. India, Brazil, France and Turkey now make up the rest of the top five, and South Africa remains in 20th position in terms of recorded cases. For now, India remains the global epicenter of the COVID pandemic. This week, an average of 800,000 new cases were reported per day, of which nearly half were in India. Brazil, with an average of 70,000, had the second highest average number of new infections per day. There is also concern over the situation in Argentina, where the daily number is steadily rising, as well as over India's neighbors Nepal and Pakistan. The Biden administration in America has meanwhile called for a waiver of patent rights on vaccines so that production can be accelerated. The daily global death toll for the week averaged around 13,000, with nearly a third of these in India. Many countries have already provided aid to India in the form of oxygen compressors, ventilators and medication. The United States, Colombia and Argentina also experienced significant increases in daily deaths, but at least the situation in Brazil seems to be improving. As of Thursday, 1.22 billion people have received at least one dose of COVID-19 vaccine worldwide. This represents just under 16% of the world's population. China leads the way with 290 million vaccinations, followed by the United States with 250 million, India with 160 million, and Britain with 51 million. It is hard to confirm exactly how many people are fully vaccinated because countries like China do not provide these numbers. According to the available statistics, at least 292 million people are currently fully vaccinated, with the United States in the lead with 107 million, followed by India with 30 million and Britain with 16 million. The US economy grew briskly during the first quarter, but while consumers were spending freely, business confidence dipped. There is also a dichotomy between the Federal Reserve, which remains complacent about inflation, and Treasury Secretary Yellen, who has hinted that interest rates might have to be raised. The Eurozone suffered an economic contraction in the first quarter thanks to lockdown measures, but sentiment has turned positive since then. German retail sales were up strongly in March, and Britain's Conservative government plans to reopen the economy in June. Meanwhile, the COVID carnage in India has led to the suspension of the Indian Premier League. Although some countries are still battling to flatten the COVID curve, the collective global mood is clearly becoming more upbeat. One example of this growing optimism is the Market Global Manufacturing Purchasing Managers Index for April, which came in at its highest level in 10 years. Manufacturing takes place in relatively well-controlled environments, and it therefore stands to reason that sentiment would improve quicker than in the services sector, which requires far more human interaction. Governments the world over have spent unprecedented amounts of money on preventing a COVID-induced depression. Proponents of a shift towards a greener economy had hoped that the fiscal stimulus programs would contain a substantial allocation to renewable energy and emission reduction. Sadly, out of nearly $15 trillion in stimulus by the world's 50th largest economies during 2020, 11.1 trillion or 76% was in the form of consumption spending. $1.9 trillion or 13% went to long-term projects like infrastructure renewal, and a mere $341 billion or 2.5% was spent on greening the economy. US President Joe Biden has made the fight against climate change one of his key policy priorities. 2 weeks ago, he convened a virtual summit of 40 world leaders, during which he committed the United States to reducing its carbon dioxide emissions to 50% below their 2005 levels by 2030. Since then, other leaders have responded in kind. China has pledged to start reducing its use of coal within 5 years. Brazil has advanced its carbon neutrality target date from 2060 to 2050. Japan has nearly doubled its 2030 emission reduction target. The European Union aims to reduce its emissions to 55% below their 1990 levels by 2035, and the United Kingdom its levels by 78%. The Dow Jones Industrial Index had another strong week, but pharmaceutical company shares dragged the S&P 500 and Nasdaq down. Rising demand for oil in the United States helped offset the drop in Indian demand, and the US dollar is firmer thanks to Secretary Yellen's musings about higher interest rates. Despite the stronger dollar, the gold price is creeping up on inflation fears, and the London Metals Exchange Index is at a 10-year high. At the Berkshire Hathaway annual general meeting, Warren Buffett announced that his protege Greg Abel will succeed him when he retires or dies. Most global equity markets ended the week higher, most notably the Dow Jones Industrial Index, which reached another new high on Thursday. Tech-heavy indices like the Nasdaq and Taiwan's weighted index were the laggards. For the past month, the Dow and Nasdaq were top and bottom respectively, but for the year to date, the Taiwan weighted is now the top dog, and China's A50 the wooden spoonist. Over 12 months, the Russell 2000 is still ahead, and the Hang Seng brings up the rear. Over 3 years, the Nasdaq and FTSE 100 are at the front and back. It's been a relatively volatile week on commodity markets, with coal, platinum and nickel strong, and cobalt and iron ore down. After a strong start to the year, the cobalt price is now down nearly 10% over the past month due to a market surplus. Despite a poor week, experts believe that iron ore still has upside. Lithium's prospects have also been dulled by a supply glut, but nickel remains the steady eddy amongst the battery metals. President Biden aims to cover the cost of his ambitious anti-poverty and infrastructure programs by raising company taxes. This includes increasing the corporate income tax rate from 21% to 28%, doubling the global intangible tax rate, instituting a minimum of 15% taxation on corporate book income, and closing loopholes in the foreign income tax regime. JP Morgan estimates that even if the earnings per share of S&P 500 companies grow by 7% this year, the proposed additional taxes will reduce these companies' earnings per share by 7%. More than 12 years have now elapsed since the global financial crisis abruptly ended the last commodity supercycle, which had been fueled by China's massive investment in its infrastructure. Resource bulls are waxing lyrical over the prospects for a new supercycle fueled by a combination of US infrastructure investment and a global swing from internal combustion engine-powered vehicles to electric vehicles. Some of the commodities most likely to benefit under this scenario include iron, steel, copper for infrastructure, and nickel, lithium, cobalt, and graphite for electric vehicle batteries. The IMF believes that global GDP growth this year will be the strongest in decades, with next year less so but still robust. The pandemic seems to have left few long-term scars on the global economy, and it is too soon to tell whether the current recovery is sustainable over the long term or merely a reaction to massive stimulus. Although inflationary pressures are building everywhere, these should recede as supply chains normalize. Average developed market inflation over the next few years will, however, be a bit higher than in previous decades, but runaway inflation is unlikely. Given the extent of inflationary pressures, central banks will probably have to start hiking interest rates sooner than they're currently saying, but later than what the market is pricing in. Even if inflation is persistent, there is a limit to how high bond yields will rise in a world with excess savings looking for a low-risk home. We must, however, point out that the post-pandemic re-rating of equity markets is behind us, and that future returns will have to be the result of earnings growth. The environment remains positive for risk assets, but we believe that different markets will come to the fore and that different sectors might outperform going forward. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are. Here at home, Minerals and Energy Minister Gwede Mantashe has been accused of rigging a tender to supply emergency electric power. It is alleged that Mantashe saw to it that the controversial Turkish company Karpowership SA landed a lucrative contract as part of his department's emergency power procurement program. Karpowership produces electricity from natural gas on ships, which are in effect floating power stations. In order to provide the 1,220 megawatt of electricity it is contracted to deliver, it plans to moor 3 of its ships in South African harbours for a period of 20 years. Rumour has it that Eskom is not in favour of the deal because of its high cost and long term. On Thursday, there were 63 COVID-19 deaths in South Africa, and the total death toll to date now stands at 54,620, and nearly 1.6 million South Africans have now been infected. The total number of vaccinations currently stands at 366,000, and the Western Cape still has the most deaths to date, and Gauteng the most infections. KwaZulu-Natal, Gauteng, and the Free State currently have the most active cases, and the National Institute for Communicable Diseases has warned that the Free State, Gauteng, Northern Cape, and Northwest are becoming COVID hotspots. The rising cost of fuel pushed producer price inflation higher in April, and South Africa achieved a huge trade surplus in the first quarter. Credit extension is still growing at a snail's pace, and South African Airways low-cost carrier Mango is about to receive another cash injection from government. The city formerly known as Port Elizabeth could run out of water by the end of June, and Rand Water is trying to avert a strike which could result in Gauteng's taps running dry. Meanwhile, the ANC has suspended its Secretary-General Ace Magashule, who stands accused of corruption. Magashule has responded by trying to suspend President Cyril Ramaphosa, who is reportedly not amused. South Africa has what is known as an open economy, meaning that it relies heavily on imported final goods and pays for them using revenue from the exporting of raw materials. Historically, our gross domestic product, the light green line, grows when our terms of trade, the dark blue line, is positive. In other words, when we have a trade surplus. The recent upward surge of our trade balance is therefore good news as it points to robust economic growth in the coming months. This graph depicts the relative value of South Africa's main exports and shows clearly that mining has contributed massively to our strong export performance in recent months. Precious metals, the red line, and industrial minerals like iron ore and coal, the dark blue line, have been front and center, with motor vehicles and parts, the light blue line, also prominent. Base metals like copper, nickel, and zinc, the light green line, are currently in fourth place. Interestingly, despite record crops, agriculture, the orange line, is only our seventh most valuable export sector. Despite spending a lot of money and effort on numerous import substitution programs over the years, South Africa remains reliant on imported manufactured goods, both for consumption and as intermediate goods. When the economy starts gaining momentum, as is currently the case, imports start to rise. Imports are not by definition negative for the economy. It depends whether they are just for consumption, like cars, the light blue line, or prepared foods, the grey line, or whether they're used as intermediate goods, like industrial machinery, the purple line, or fuel and lubricants, the orange line. It is heartening to see that much of our current import bill is spent on inputs into mining, industry, and agriculture rather than on consumer goods. The JSE had an indifferent week, weighed down by its two technology titans. Despite this, the all-share index is up by nearly 12% for the year to date, with resources and listed property the best performing sectors and banks the laggards. Government bonds and the rand were both initially under pressure, but ended the week stronger. Meanwhile, MTN has become the first cell phone network to seek a listing on Rwanda's Kigali Stock Exchange. Foreigners were net sellers of South African securities last week, with nearly 2.5 billion rands worth of foreign capital flowing out of the JSE and the bond exchange losing nearly 3.9 billion rand. For the year to date, foreign outflows from our markets total 10.6 billion rand for the JSE and 40.8 billion rand for the bond exchange. The recent strengthening of the US dollar has led to a general depreciation of emerging market currencies, with the notable exception of the Brazilian real, the grey line. The rand, represented by the dark blue line, has weathered the storm reasonably well. It started off the week at more than 14.40 rand to the dollar, but has since managed to claw back some lost ground and was trading at around 14.25 rand on Friday morning. NASPERS and its sister company Prosus make up more than a third of the JSE's market capitalization, and their performance therefore has a proportionate influence on the all-share index, the top 40 and the industrial index. Things have not been going all their way of late, as Tencent, the Chinese online giant in which they each have a big stake, is under attack by the Chinese government for what it deems monopolistic behavior. The pressure on Tencent has resulted in the share prices of both NASPERS and Prosus declining by more than 10% over the past month. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx asset allocation view can be summarized as follows. We remain overweight global equities because of the greater opportunity set they offer and our long-term concerns over the structural vulnerability of the rand. We are gradually adding to our local equity allocation and remain neutral on global property. We still avoid local property because of the uncertainty over the long-term health of the sector and hold no global bonds unless specifically mandated to do so. We are also maintaining our tactical overweight position in local bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.